Hello viewers and welcome to another episode of Excel Learning. In today's capsule, I'm going to talk about a topic which will help use Excel to decode India's new labor law which is effective November 25, and I'll help understand what is the financial impact simulation in different scenarios. This is particularly useful for HR professionals as well as their respective FP&A or finance business partners in making an informed decision around how to go about the same. A lot of large organizations like TCS, etc., they have taken a hit in their profitability, and I'll explain with a clear example what are the different scenarios possible, how can you leverage those, and what is the best fit from an employee point of view as well as from an organization point of view. And we'll use Excel to model our capabilities and try to explain it in a simple way. So without any ado, let's move on to it. First of all, let us understand what this change is about. So this change is about defining wages, number one, and number two, the criteria for defining basic plus dearness allowance. This is the basic funda which is being rolled out, or rather has been rolled out effective November 2025. And the law basically says that if the payments allowances other than basic and dearness allowance are more than 50% of entire remuneration, then that amount exceeding 50% shall be added back to the wages. Now that sounds complicated. Let's try and simplify this. The simplified version is, if your basic plus dearness allowance as a percentage of gross before employer's contribution to PF is less than 50%, it has to be basically made up to 50%. That's basically the understanding. What does this mean? If we divide our salary into multiple headers, you don't need to look at the entire sheet. Let me just hide it for the time being. You need to just look at the components of it. Let me increase the size. So if you divide your salary into multiple components like basic, HRA, special allowance, employer contribution to PF, leave encashment, PLI, etc., this change basically mandates that whatever amount appears in your basic line, it has to be at least 50% of your gross, and that gross is defined as gross before employer's contribution to PF. This is basically the change that has been brought in. Now let us try and understand with an example how it is taking place, what is the impact that companies and employees would have considering the different scenarios that are possible, and how do we strike a balance. So now let's say a person is at a CTC of 10 lakh rupees per annum. All these numbers are per annum, which is per year. And let's say the overall CTC for the company for an employee is 10 lakh rupees broken down by components. So you have 2,90,000 in the basic, you have HRA 1,75,000, special allowance, you have a subtotal of gross before employer's contribution, then you have employer's contribution to PF, you have the gross fixed which is before employer's contribution to PF, and the contribution to PF if you add, then you have the leave encashment. In this case, I have taken he is eligible, or the employee is eligible for 10 days per annum leave encashment if he is not utilizing his leaves that are given to him. Performance linked incentive has been taken as 20% of the gross. Then you arrive at the CTC as per letter. Then you have gratuity, which is again 4.81% of the basic amount. This is as per statutory mandate. Then you have overall CTC for the company, which is 10 lakh rupees. Now, what are the alternatives possible for the company? The alternatives possible for the company are basically three alternatives. First alternative is keep gross same. Second alternative is keep gross including PF same. And the third alternative is keep CTC same. Now let me explain each. Now you can see the yellow colored cells over here. So in the first scenario, the company will keep this number as constant and rest of the numbers will be derived. In the second scenario, the company will keep gross fixed constant, which is this blue box, which is inclusive of earlier gross along with the employer's contribution to PF, and the rest of the components will be variable. And the third scenario is basically where the company will keep the overall CTC as constant, which is, let's say, 10 lakh rupees in this case, and everything else will follow suit to accommodate the 50% criteria for the for the basic and the dearness allowance. Now let us understand how it happens. In your original scenario, which is pre-November 25, let's say this was the status. So basic was around 38% of the gross before employer's contribution to PF. This was the scenario pre this new labor laws. Now what is our objective? Our objective is such that this number when divided by gross before PF should be equal to or greater than 50%. So this is where we want to reach. Now here I have already reached it. I'll show you how to reach that. So these are the three scenarios, and let us see first what are the outcomes in each of the scenarios, and then we'll consolidate. So let me just hide rest of the scenarios for your ease of understanding. In the first scenario, what we are doing is we are freezing this one, which is we are freezing that the gross before employer's contribution to PF shall be same as the pre-regulation or pre-November 25 number. So we have frozen this. Then we have taken 50% of this for basic, and we have further taken 50% of that for HRA and balance as special allowance. Now for this, the mathematics that I have used is basically 50% of remaining split equally between HRA and special allowance, so that this forms the balance 50%. That's the psychology that I've used. Now what happens essentially, your employer's contribution to PF is formula linked, so it now moves from 34,800 rupees to 46,099 rupees, which is 11,299 rupees extra money that flows in your account or on your behalf to the government account. Now it essentially increases your leave encashment also. Why? Because leave encashment is a function of how much is your gross fixed. So for the same 10 days leave encashment that you were eligible earlier, now you will end up making 314 rupees extra. Similarly, if you look at the performance linked incentive also, because it is also a 20% factor on gross fixed, you will end up as an employee making up 2,260 rupees more. Also, gratuity, which is 4.81% of your basic. Now because your basic has been revised, you will end up making more money even on that, which is to the extent of 4,500 rupees. And if you see the overall maths, you will end up making 18,400 rupees more on the overall CTC level. Now this is what large organizations have actually followed, including TCS. And if you see, the percentage increase is roughly 1.8%. This similar percentage is there for TCS also. So if you see, this is the last quarter, I mean quarter 3 numbers of financial year 25-26 for TCS. And if you see, the employee benefit expenses was 109,026 crores, and the statutory impact of new labor code was 2128 crores. Now if I were to do a simple maths to say 2128 divided by 109,026, you would see that it would flow to a similar 1.9 to 2%. So that is what major large organizations have done. Now coming back to our analysis, this is the first scenario. Now let me go to the other scenarios. My alternate 2. In alternate 2, what is happening is, we are keeping, or the organization is keeping, the gross fixed as constant, and hence 803,118 is kept here to be the same amount as was before the regulation. Now everything else is back calculated. So here the number for employer's contribution to PF is back calculated using 212% and multiplying it by 12%. Similarly, this number is divided by A minus B, and then you have rest of the numbers which are fitting the bill of 50%. Essentially, in this, what is happening is the employer's contribution to PF is definitely increasing, but it is being compensated by a reduction in the other allowances. So if you see here, your number is changing from 34,800 to 46,460, which is an increase of 10,660 rupees. However, if you see earlier, my other allowances were 478,000. Now it is becoming 378,000. Or in other words, my gross before employer's contribution was earlier 7,68,000. Now it is becoming 7,57,000. So if I were to simplify, this is getting nullified. So there is no impact because you have kept this number as constant, and hence everything else is back calculated. Now, what is the real benefit to the employee in this case? The real benefit is gratuity any which ways will increase because you are revising your basic. So your gratuity number will increase by 4,273 rupees. Now, just to put it into context, earlier you were in the scenario 1, the employee was making 18,400 rupees more, whereas now he will make 4,273 rupees more. So the reduction is coming because the organization took a call to keep one layer constant, essentially meaning that everything else becomes backflushed and the only benefit employee has is in the gratuity line. So this is scenario number 2. Now coming to the third scenario, which is also possible. Let me just unhide the columns. Now, if you see the scenario number 3, let me just hide the rest of the columns. In scenario number 3, let me first explain what is happening. So, the organization is keeping the overall CTC constant, which means the 10 lakh should remain 10 lakh. However, this criteria of 50% will be satisfied, which the law requires. So, how it is going to happen? First of all, let us break everything as a function of basic in order to derive a formula. So for example, here you see this elongated formula over here. Do not be intimidated by it. I'll explain it in details. Let us say everything is a function of your basic amount. And if you define your basic amount as 1 rupee, let's say in this case, if you define your basic amount as 1 rupee, your HRA becomes 50 paisa as per our earlier formula. Your special allowance becomes 50 paisa given your total gross before employer's contribution to PF becoming 2 rupees, and here the criteria of 50% is getting satisfied. So 1 on 2 rupees, 1 rupee as a percentage of 2 rupees is 50%, so that criteria is satisfied. Now move to employer's contribution, it is 12% of basic. So you have gross after employer contribution to PF. Now you move to leave encashment, which is again a function of 10 days on annual 360 days. So assuming the year is having 360 days, you are having 10 days of leave. So that also gets quantified in terms of a function of basic amount. Similarly, the 20% PLI or the performance linked incentive is also linked over here. So you get your total CTC as 2.603 rupees, and the gratuity will again become 4.81% or 0.048, giving you a total CTC of 2.651. Now, why have we done this exercise? The objective of doing this exercise is to derive that if I want to find out the basic in this scenario which satisfies the 50% criteria, I will require this number as an equation to frame the overall 10 lakh rupees split by different components. Now, this is a very simplified version that I have shown and it really works. Now, let me just show you. Now here, if I were to just select all these numbers, which I have pasted here, and if I were to just show you a sum, now see here, it is reflecting as 2.6509. It is the same number as this. So what essentially I have done is I have converted it into a function in a linear function y equal to mx plus c, and that is giving me the 50% satisfying criteria. Now, in this case, what essentially is happening? Now, everything else is flowing according to the formula. Now, what is happening here? Essentially, the employee is not getting anything in return or anything extra because the entire 10 lakh is frozen now. Everything else is back calculated. So, I will give this Excel as a download option. You can go there, you can play with it, and you can fix your own way in which you want to operate your, the formula in which you want to give out as an organization. This is very useful for HR folks. And now let me just unhide the entire columns, and now let me just show you the final analysis. Now what is happening here? Essentially from 38% to 50% in each scenario we are reaching. However, in each scenario the freezing point is different. In first scenario the freezing point was pre PF contribution. The second scenario the freezing point was post PF contribution, and the third scenario the freezing point was entire CTC. Now if you see the result, in scenario 1 your CTC is higher by 1.8%. In scenario 2 the CTC is higher by 0.4%, and in scenario 3 it is at par, which is nothing to lose, nothing to gain. But still, let me highlight what does the employee actually lose or gain. In scenario 3 the employee actually stands to lose if he has not spent the required years, which is 4 years 240 days, and is not eligible for gratuity. Then this number which got revised and the benefit of 4195 is just a book number. It is only beneficial for those employees who have actually crossed the threshold. Similarly, in scenario 2 as well, the employee doesn't get too much in return because it's a marginal revision that happens, and gratuity he is eligible only after a particular period of time unless he or she is a contracted employee. The best approach for organizations or from employee welfare standpoint is basically alternative one, wherein the employee stands to gain. I would strongly recommend HR folks to go through this, but having said that, views expressed here are completely personal, and HR teams are advised to exercise their own due diligence and their respective case in point before implementing any action. I want to give credit for this video to one of my very close friends who and I worked together on bringing up this business case together. Thank you so much for partnering with me on this, and see you in the next video. Thank you so much.